Is this market ready to crash, or are we going to make another run up at the all-time highs? These are the questions that I have been hearing all week long. It has been a very tricky market to read, no doubt about it. We have had swings back and forth out of nowhere on every little Iran headline, and I don't see that changing anytime soon. However, I want to take a look. Today's close was very, very important. It was another important stand by the bulls. They defended some pretty key support levels. So I want to walk you through what I'm looking at on my side. In order to put some new capital to work, which I would like to do, there's some things I would like to see develop out of price first. So let's jump in and take a look at this daily chart of SPY. If we take a look at the range down at the bottom, the ATR, the average true range is approaching 9. The intraday movement has been phenomenal. The missing piece, however, has been the follow-through. We have not had a lot of follow-through for more than a few hours at a time. When we take a look at the headlines, you take a look at some of these numbers popping up, it may seem like you're missing out. If you're on the sidelines, you're missing out on a once-a-year opportunity, but you're not. If we take a look at the big picture, to put some context around this, look at where we closed today, right in the middle of the range that's been in place for the last few months. All the headline risk, whether it be with interest rates, with the Fed, now the conflict with Iran, the trade wars, the tariff situation. You go down through that big long list, the market continues to brush a lot of this news aside. And big picture, we are just stuck in the range that's been in place for the last few months. If we're going to see some cleaner movement outside of this range, there's a few levels that I'm keeping a close eye on. On the upside, look at 690. Anytime that we've approached 690 on the upside, it's like running into a brick wall. It's been very difficult to break that level. Anytime that we've tested it, it's been very short-lived, and we sell right back off to the downside. If we're going to break up towards that all-time high, need to see a close above 690. Very, very important. Until that happens, we're going to continue to see the rally stall out, continue to see the choppiness kick in. On the downside, even more significant here, look at those blue lines on that daily chart. Those are the 89 and the 100 period EMAs. We are now up to 7 examples over the past couple of weeks of those levels being tested and the bulls stepping in to defend them each and every time. Look at the low today. We tried to break below those levels, and almost immediately the bull stepped in, didn't take us back up to positive territory. The index market still closed lower on the session, but we closed off the lows enough to get us back above those moving averages. That's the level. The 6 on the downside, that 677 level, let's get me get that exact value for you here. Let me get my data box up. 677.84 is the level that needs to break on a closing basis. And the reason the bulls are defending these levels every time, because look, if they break, look at that air pocket all the way down to those red lines. Those are the 200 period SMA and EMAs. We could test those levels very quickly if we get a close below the 677.80 level. That's why it's so important to watch that level here over the next few days. Until we break either above 690 on the upside or below 677.84, we're really in no man's land. Don't just rush into things. Don't just take trades for the sake of being active. Really be picky. Now, one of the markets that's popping up on my radar for tomorrow's session is USO. This is the oil ETF. And I know it. You hear me talk about oil. Why do we want to mess around with oil right now with the war ongoing? Wouldn't that be an area we'd want to stay clear of? Well, let's take a look what the numbers are saying. Let's set the headlines aside. We can't control the headlines right now, right? But we can evaluate the numbers and see if there's an opportunity there strictly based off of those numbers. Looking at this 130-minute chart, look at that pulse indicator down at the bottom. It just plotted green again today. That indicates that price is past a 2 standard deviation move. Doesn't mean we can't move higher from here. It just means we're at a point of interest where historically it'll typically lead to a period of consolidation or a reversal in the other direction. Could potentially be a point of exhaustion in the near term. I'm not trying to pick a market top on USO long term. I'm just looking for a trade in the near term. Right? The numbers don't back up an explosive move higher from here. If it happens, it's going to be an outlier move. I don't want to place a trade with the expectation of an outlier move happening. I'm trying to place a trade based on what the numbers are going to tell me long term. We're overbought in the near term. I'm interested in selling a call credit spread. Why sell a spread versus just buying an outright put? Well, here's why. If I go over to the trade page, down at the bottom, look at that today's option statistics section. The IV percentile is at 100. The implied volatility is a big input in the pricing model of an option. It has a big impact on whether those options are expensive or cheap. When I see an IV percentile at 100, that indicates over the past 52 weeks we have had no other occurrences with volatility higher than the current levels. Doesn't mean we can't see that volatility stay high for a longer stretch, but it does mean at some point markets will normalize. Market makers are pricing in the worst possible outcome on oil. They're pricing in oil is going to continue to zoom to the moon. What if it doesn't? What if we start to see some positive headlines out of the Iran conflict? What if we start to see oil pull back a little bit? What's going to happen to volatility? They're going to suck all that high volatility right back out. That fear premium that's been baked in is going to start to get pulled out. If you buy an option right now, you're going to fight that. Buying an option on USO, you are paying up. Those options are expensive because of all the fear premium priced in. Instead, by selling a call credit spread, now I take advantage of the high volatility. I can sell options that are further out of the money, still collect a decent amount of premium, and start to give myself a higher probability trade. Here's what that looks like. Let's go out to the March monthly options with 15 days left, and let's go out and sell the 100-102 call spread. All that means is I'm selling the 100 call, buying the 102 call to make sure I'm in a risk-defined trade. The whole goal of this trade is for USO to stay below 100. I don't care if it moves up, down, or sideways. As long as it stays below 100, I'm okay. I also make money from the time decay adding up. Every day that passes, that helps me. I also make money from that volatility contraction if we start to see that high volatility come down a bit. Now I give myself 5 ways of making money on the position. Starting to stack the numbers in my favor. Notice, I'm not saying anything about the headlines here, but this is strictly based on volatility being high and the overbought condition on that 130-minute chart. If I were to put this trade on at 57 cents, I'd be collecting $57 per spread, risking $143 per spread. That's my max risk on the trade. That's the most I can lose. And the only way I lose the entire 143 is if I hold all the way up to expiration and it goes against me the entire time. I can always close the trade out early and take a partial loss if needed. How I would manage this trade, the $57 that I'm collecting up front, I'd be looking to close it out when I can keep half of that. So I'd be looking to buy the spread back at 28 cents. I like to use a 70% stop on my credit spread. So I would take that 143 max risk, take 70% of it, which is right at $100, add in my entry credit of 57, and that would leave my stop at $1.57. If I get out right there, it leaves me with a $100 loss or a 70% max risk outcome. Again, not going to wipe me out, not going to leave me in a large drawdown. It's not going to be fun if it happens, but I'm limiting the damage, right? It's fully risk defined. I know what my max risk is right up front. These are the types of opportunities that I'm looking for all the time. I'm looking for the numbers to dictate the best opportunities, the highest probability trades for us. So that's a trade that's setting up for us on Friday. I haven't put the trade on yet. I will revisit it tomorrow, see if we can get it on, see if we can get some capital to work. All right. So again, takeaway, the opportunity is coming. We're in a big range on SPY. As soon as you break that range, that's the time to get aggressive. If you have any questions on what we continue to look for on our side, you can always post a comment here on the YouTube video, or you can reach us, info@netpicks.com. We're more than willing to help out there as well. So I'm going to wrap this video up here. I'll be back with you guys over the next few days with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk